Hello, everyone. Welcome to today's Jones & Roth Small Business Webinar. My name is Teresa Rickard. I lead our practice growth and marketing team here at Jones & Roth, and we're so glad that you've joined us for today's session. We're going to be diving into the topic of year-end planning and talking a little bit about financial considerations and tax planning opportunities for small to mid-sized businesses. At the end of our presentation, we will have time for a Q&A, and this is a really great opportunity for you to ask questions about how this topic relates to you and your business. So at any time throughout this presentation, please go to the questions panel right there and go to webinar, and we will answer those during our Q&A session. Also, if you go to the handouts panel, you can download a PDF of today's slides, and this webinar is being recorded. We will be emailing you a link, so you will have that to watch on demand or to share with others. All right, well, before we get started, I'd like to give just a short introduction to our firm. Jones & Roth is one of the largest CPA and business advisory firms that is headquartered here in Oregon. We serve businesses, nonprofits, and individuals from our offices in Eugene, Bend, and Hillsborough. And specifically, our small business team works with small to mid-sized businesses providing coaching, tax and accounting guidance, employer support. Our mission is to help owners reach their professional and personal financial goals. And today we get to hear from two of our advisors, Certified Financial Planner Matt Adams and CPA Jordan Dawley. Matt specializes in comprehensive wealth management for our clients, and whether it's advising on investment strategies or retirement planning or insurance, or whether he's providing guidance regarding estate planning or gifting or business succession planning. Matt brings over 25 years of experience to his relationships with his clients. So Matt, we're pleased to have you. And Jordan Dawley specializes in strategic tax planning for both business and individual family clients. He is an active coach and advisor, working closely with his clients to achieve both short and long-term goals. And his extensive business tax and advisory experience spans a very wide variety of industries. He serves as a key member of the firm's healthcare and dental teams, and he is also the audit chair of the local chapter of the Risk Management Association. All right, welcome to you both. We'll kick things off today with Matt. Matt, welcome. Thank you for being here with us today.
Thank you, Teresa. Thank you very much.
Yeah.
My intent today is to provide sort of a roadmap or some guidance on how to come up with solutions, particularly in my world as a financial advisor, a certified financial planner. There's just a plethora of options that are out there and things to consider. And so rather than throwing a bunch of solutions at you, my thought today was to give you the steps that you can find those solutions, because everybody's on their own journey. Everybody's looking for their own personalized solution that fits their situation. I have been in the business for 25 plus years. What I want this to come away with for you is that if there are areas of concerns that you want to address, you know the steps, you know what it is you need to do to find the solutions, either yourself or using advisors. I do this because I hope that there's opportunity to work with some of you, but that's not a prerequisite. I do this more importantly because I enjoy it. Over these years in working with other clients, I just really enjoy getting to know how folks have made their money, how they've created and grown their business. I get to live vicariously through them. They make businesses out of things that I didn't even know existed. I have one example, long-term older client that I haven't worked with for a while. He's passed, but he was an engineer. And when first meeting him, thought, okay, that's how he made his wealth. He created his wealth is by his engineering practice. But where he made most of his wealth, and it was substantial, he did engineering work for municipalities and governments to determine where growth, where roads, bridges should be built. And he used that knowledge It's not publicly traded, so I don't think there was any insider trading going on. But he bought the land and the path that he did the work for these municipalities, these developers, on where the growth could happen. And as it did, he just sort of bought the land, waited till the growth came, and then he sold it to those developers. That's one of the more intriguing to me of someone that created substantial wealth for them and their family, and not necessarily the most obvious way. And spending a little bit more time on that particular topic, I guess this is speaking to my passion, but I love the story of Levi Strauss. Followed the gold rush to California, was going to sell tents to the miners. That business didn't take off, but he found that they were tearing through their pants. And so that's how we have blue jeans today, is he took those tents and turned them into blue jeans, a multi-generational, multinational company. But thank you for bearing with me through that introduction. Sort of stepping into what that path looks like and those considerations, kind of laying that out. The areas that I suggest that you segment, or an advisor that you're working with segments in the sort of the life cycle of a business. One, you need to make some money. You got to make it work. You got to get it done. You find and work with trusted advisors to help you on the right direction. That next step is once you've made money, once your business is profitable, the next consideration, the next worry is, how do I keep it? I don't want to lose it. All this effort, all this growth, I don't want to give it back. I don't want that stone to roll back downhill. The third step, or the third segment that often people consider, is how do I build my own personal security and wealth? That actually reinforces the first two, because if you're secure, your employees are secure, the people that you've hired, key members, all building and feeling secure in their own personal situation, can give effort to making money and keeping that money within the firm. And then finally, how do you plan that next stage of life, exiting the business? That can look very different for many people, but how do you position the practice or the business so that you can step away and be secure and receive fair value for it? That's an overview. And again, I'm going to stay fairly mile-high perspective. I'll dig a little deeper as we get further into it. But taking a closer look at that first step that I talked about, you have a lot of choices. One bullet point here is choose the correct entity type for your business. You do want to find a good advisor to work with, be it an attorney, be it a CPA. But one of those first decisions that you're faced with is, should I be a sole proprietor, an LLC, an S corp, a C corp? I'm a financial advisor. I look into the future and run projections for clients. Accountants, which Jordan will be stepping in later, can give you guidance on today, what puts you in the best financial situation. Now, what I would say the action item here for you is each one of those business entities has their own benefits. But what I consider, what you should consider rather, is doing your own SWOT analysis. We're all familiar with it, but just a reminder and a review, what are the strengths of your business, you and your business? What are the weaknesses of your business? So the internal focus. And then the opportunities and threats, those are the external. The opportunity, what is it that your business using those strengths can take advantage of those? That's a great place to start, sort of your note taking of how to approach an accountant or attorney or other advisors to help you on the right decision there. You want to continue to build on those strengths and take advantage of those opportunities. So invest in yourself, invest in your business, get any necessary licenses, purchasing equipment, and your own personal growth. I often use this analogy, whenever possible, you want to leverage others. This example that I use is, if you have a top athlete, Milwaukee Bucks has a player his nickname is the Greek freak because of his physical attributes. He's sort of a genius physically, very tall, very agile. He could probably do his own landscaping at home. And I know this is an exaggerated, sort of silly example. He could do his own landscaping at home. He could mow his yard probably faster than anybody else because his stride, probably covers 10 feet. His wingspan, how high he could raise his arms, he could probably clip his own trees. But like I said, he's a top performing athlete. He makes millions of dollars a year. And again, I know this is a silly, exaggerated example, but it's maybe help you focus on, are there areas where you're doing things that you could transition to others, delegate as much as possible? Some thought around that. Little reading that I would suggest. It's been in publication for a while, but it's still very applicable. It talks about working on your business, not in it, and it's called The E-Myth by Michael Gerber. Many of you've probably already got it, but it's on Amazon for less than 15 bucks. So if you haven't read it or you haven't visited it in a while, I suggest you go back and take a look at that. But first, you do have to focus on the profits. You do have to grow your business before you really have to consider anything else. So this is basic building block. And once you've accomplished that and segmented that, then you can go on and look at sort of the next panel of addressing that. You've achieved profitability. You've got a level of security. How do you protect your business? And we got the bullet points here. You want to hit that checklist. You want to, have the right errors and omissions, insurance, professional liability, business liability, workers' compensation, etc. You want to have a trusted advisor that you're working with there, somebody that knows your business, maybe somebody who specializes in your line of business and the special risk that exists there. Most people understand that, but just again, a review, kind of running down the bullet points. Once you've got that though, if you dig a little deeper, some other things that you should look at and that you should consider is your ability to work, for example. If you're the one making it happen, and you're not able to show up at work, through many different reasons, but the ones that are most common that are thought of and significant risk to a business is death and disability. Things like disability insurance protect you against the income loss if you're not able to show up. And then there's another line of insurance. I don't specialize in these. I can't help people with them though. Is overhead insurance. That's if you're not able to work, but you want to have a business to come back to so that you're able to meet payroll, you're able to keep up on the rent. Those are things that you want to explore. Think about the risk of you not being able to go in, not only to you personally, but to the business. Other steps going a little bit deeper, looking at key employees. You've taken that advice, you've mitigated, you've delegated some work to other people, and you've got some real stars in your organization, and you want to protect them. You want to keep them happy, but you also want to protect the business should they not be available to continue to work with you. That's important. Obviously, the name key employee is the indicator right there. In this case, kind of going back to that SWOT analysis, looking at action items there is, what are those internal weaknesses? You know better than I. I've touched on some common ones here: your ability not to continue to work, what that mean for you personally and to the business, and then also key employees, if they weren't available to continue to work or available to you. What are those internal weaknesses and external threats? External threats, obviously, going back to sort of the top of my conversation on this particular panel, errors and omissions, business liability, workers' compensation. Those aren't really things that you necessarily set it and forget it. You do want to go back and review those. So this is sort of a continuous cycle. The next thing that I would, touch on is that third panel. Hone in on a benefits package. This is where your personal goals and values, starting to merge with the business. This is where you make your business and your practice more attractive to current and new employees. But you also want to be, realizing fair value for yourself and your family and your future goals. And this common theme, you're going to hear me drop it a couple of times, but again, that's SWOT analysis: strengths, weaknesses, opportunities, and threats. So this is I would suggest doing a personal SWOT analysis. What are the strengths in my current situation? What are the weaknesses in my current situation? What are the opportunities that I have that I might be able to take advantage of? And what are these external threats that might threaten all of it? And this particular piece of it, this is where you get a lot of outside vendors, service providers, they'll approach you. And there's a huge catalog of choices and options, and sort of tying in with what I mentioned earlier. It can get overwhelming. What's the right choice? Am I protecting against a risk that isn't really likely to happen, and I'm ignoring one that really is a challenge? Are there opportunities to grow wealth outside the business that I'm not taking full advantage of? I'll lift out one particular category. We've got 3 bullet points here: retirement plans, health insurance, and fringe benefits. Retirement plans, everybody should have a retirement plan. What that retirement plan looks like should be different. If there's, how many people? We got 42 people on the call. There's 42 different retirement plans that is ideal for them. They provide the opportunity to build wealth outside your business and your practice, giving you some diversification and security because it's outside the business. There's all sorts of wrappers and protections against those funds built out there. There's also some tax benefits to doing that, which I'll let Jordan speak to more. But again, those choices can be overwhelming, and not that anybody's taking notes, but if you are, don't write these down. But just for example, the choices available in retirement plans: there's IRAs, there's Roths, there's Simples, there's SEPs, there's 401ks. Which one's right? Any one of those could be right for any one of the 42 people on the call right now. And again, the action item on this is that personal SWOT analysis. Consider the advantages. So the notes, the bullet points you want to take when you sit down with that trusted advisor, whoever that might be, is consider the advantages that you want to create for yourself. What is it? How is it that you want to take this successful business? How do you want to advantage it for yourself? And are there tools that help you do that? Be honest with yourself when you do that. Are you looking for a tax benefit primarily? There's plans that do that right off the bat. Do you want something easy, simple, something that you don't have to think about a lot? Or do you just want to be staying competitive for new employees, in a competitive marketplace? Having those thoughts, having those priorities, having thought that through for yourself, that'll help a trusted advisor narrow down the options so they're not overwhelming. It's just helpful to get the process started, and that's just on retirement plans. Follow the same process for health insurance, risk mitigation, and then fringe benefits. That's more of things beyond what is typical. That's all it means. Are there things that are beyond the typical that we could take advantage of? Moving on to sort of my last bullet point, preparing for your exit. The bullet points here, again, this is where your personal goals really come into focus. Your personal goals that relates to the business. How do you apply that to your practice? Are you able to sell it? Many businesses, when you exit, that's the business. But for others, that's not the case. And are you able to sell that practice? Even if you're not able to sell your business, you still need to be planning for this. And there are other assets that related to the business that will be retained. For example, the the building, the real estate that the business operates out of, can that be peeled off and treated separately? And will you retain ownership in it when you make that transition out? The succession planning cycle, I've got sort of 6 steps here on the next slide that talks about, number one, what is the ideal when and how? Define that plan. What's the ideal? Think about, allow yourself to think creatively and aspirationally. When and how does that process happen? Second, know the value, put a number on it. People can help you do that. Oftentimes people say, when I reach this particular goal, this number, that's when I think about stepping away, or that's when I'll step away. Advisors, financial planners, they can help you with that number if you don't know what it is or what's needed based on your personal goals. Next, identifying a buyer. Will it be a third party? Will it be a current team member? Who is that is going to take over the business if it can be sold? And if not, if you're stepping away and the business stops with you, are there current clients that you want to transition to another provider? Number 4, flesh out the details on how to make that happen. Structure the transaction. What's it structured? What's it look like? Then put it all together, organize that plan, and then execute your plan. The action item on this isn't necessarily for you to come away and come up with each one of these steps. There are advisors here at Jones & Roth that come alongside you and help with those considerations, but formulate your ideal exit. Seek that advice from a trusted advisors. The exit, the choices that you make on the exit, they do have their consequences. There are risks involved. There's taxes involved. There's always taxes involved. And then there's also your own personal well-being. And then just finally wrapping it up, these steps, these thoughts, these action items, which really start with your own strengths, weaknesses, opportunities, threats, and your personal goals. You should revisit them periodically, at least annually. Business valuations change over time. You've maybe taken on new partners or owners in your business or practice. If you've set something up, you've have these strategies in place and you haven't visited them in 5 years. In 5 years, think about how much has changed in your life, in your business over the last 5 years. I don't think anybody has been untouched in these last 5 years, and it's worthwhile to go back and revisit those. If you started your business and know exactly when it is that you want to exit, that's awesome, but not everybody's there. Following these steps, taking these action items and formulating, hopefully this is helping you formulate the questions and goals that you might establish for yourself. You want to come back, you want to visit them, you want people coming alongside you and helping with that. And hopefully these helped organize those. Each one of these panels, these pages, you can follow them sequentially, but you don't have to. You might already be profitable. You might already feel somewhat secure, but you want to go back and revisit that and see if you got the right business structure, because of ownership changes. So they don't have to operate sequentially, but I broke them down in this so that they're sort of organized in a logical pattern, sort of a logical grouping. The goal of this is so that you have enough information to make decisions. So because you're a business owner, you're an entrepreneur, you're a provider, you've got other decisions to make. So gather the information needed from people that you trust, and then make the decision and move on, and then go back and revisit it and see if that was the right call. Do a debriefing, and a good way to do that is once a year, take a look at that. I don't want to take too much of your time. I want to give some time to Jordan for him to share his knowledge, and he's a great guy to listen to. But thank you so much for your attention and your interest, and I'll let Jordan step in now.
Awesome. Well, thanks, Matt. That was beautifully said. Always enjoy hearing stories from you, and we'll certainly welcome you back in and Q&A here at the end. I am proud of you for bringing up the Greek Freak and also not having an attempt at pronouncing his last name. So from that standpoint, that is not an easy one. So that's why they call him the Greek Freak, because the name's fairly complicated. All right, so Matt kind of set the table. We're going to pivot now and talk about some tax implications of some of the things he laid out and things in general we talk with our clients about in terms of planning. Most people think of tax planning as a year-end occurrence, but certainly it's best done as a proactive approach. Year-end works, but sometimes it makes sense to have more frequent check-ins, and that's something we pride ourselves with our clients. So the big takeaway here, I don't have a formal disclosure as Matt had there in the beginning, but is that this material is intentionally generic, right? Because so much in tax law depends on your specific scenario. So certainly take away these points as a starting point, but reach out to your advisor. Hopefully you have one. If you do not, we recommend you locate one as soon as possible. So yeah, there's no one size fits all to tax planning in general. It's so facts and circumstances specific, but we'll talk about some opportunities you may want to implement for yourselves. The big takeaway here is that you should be leveraging that proactive advisor to shape the tax planning around your circumstances in general, and that's best done on an ongoing basis, right? Matt had mentioned before, one of his early steps, right, is to consider your entity in general. And we frequently, when we're prospecting with clients or when a new idea, new business gets formed, the first step of the reporting to us is, hey, I have an LLC. Which is fantastic, right? An LLC is a state statute, recognized legal entity, which separates legal liability from yourself as an individual. But that does not tell us how you're going to be taxed, right? The four main common strategies or entity options, I should say, would be a sole proprietor, or also referred to as a disregarded entity, partnership, and then there's the S corporation or C corporation. Right? And there's different reasons why you might utilize one of those entities over the other. And we'd like to talk in general about starting with the end in mind from an ideal standpoint in terms of when an idea is structured and a business is formed. Is your intention to keep that as a small, closely held business? Do you have aspirations of growing that to the point where you're potentially acquired? Because those facts and patterns would shape how we'd want you to form early on. Probably the most obvious example of that is a somewhat slightly known tax code. Section 1202 of the tax code is a small business stock gain exclusion. And the important takeaway here, it's an opportunity potentially to exclude up to $10 million when you sell the stock of your entity. However, you have to be an initially formed and stock issued as a C corporation. So that's kind of an early look through as to why you might want to be a C corp. However, a C corp's quite inefficient in a lot of other realms and in a lot of other long-term intentions for a business. So the big takeaway here is chat with somebody. There's always opportunities to make elections and pivot to other entity types, but you'll want to have consideration as to when to do that or why to do that before you do that overall. So some of the takeaways we generally talk about year end. I love prioritizing retirement in general, not just because Matt and his team does a fantastic job, but I view it as another way to pay yourself, right? So depending on your structure, you may be paying yourself in wages as well. And of course, as a business owner, you recognize some of the benefit of those profits. But if you can also prioritize retirement funding and utilize the power of compound growth, that's a way to really get a jump start in terms of benefiting yourself long term. But there's also, of course, tax benefits to that. One of those would be the retirement plan startup. There's a new credit, relatively new. It's been around for a couple years now, but the credit allows you to effectively get a credit for the costs of administration and setup of your retirement plan if you don't have one, and it also will cover the costs and forms of a credit relative to employee education around the ability to contribute, informing them about investment options for their plan and such. So that's been a somewhat lucrative one for clients who have been on the fence about starting a 401k, and they've potentially not done that because administration can be, somewhat costly early on when you're getting going. This is a way to soften that blow. One of the things Matt mentioned, somewhat tongue-in-cheek, is that there are 42, options of retirement plans. There are a lot out there, and some people are of the mind that they need to wait until they're big enough to start a 401k, and that's certainly the most widely known version of a retirement plan. But there are absolutely suitable options out there that, again, facts and circumstances could lead you to one option over another. A SEP IRA, a simple, have different leverage points than a 401k, and even a cash balance plan. That's one that often isn't heard. So the traditional 401k is what's known as a defined contribution plan, which means the rules designate how much you can contribute, right? It sets a ceiling in terms of how much you can put in each year. Now, the risk of that account in terms of its growth and meeting your retirement needs is on you as the funder of that account, right? If you reach retirement and there's a market collapse around that time, you're going to have a smaller portfolio, right? You're bearing that risk. Whereas a cash balance plan is an example of what's known as a defined benefit plan, where you use effectively an actuarial related calculation to say, what is the benefits I need in retirement? And then you back into the funding amounts that are needed in the current year. And those can be quite tax incentivized, but there are a lot of rules. We usually don't bring those up for clients until they're 5 years or more, or closer, I should say, to retirement, because there's a lot of specific rules about opening the plan and how long that type of plan is open. So just an illustration as to why some of those plans might work and some might not. On the individual side of things, this is one that's kind of an easy one to leverage, is the harvesting of capital losses. So if you have an after-tax brokerage account where you have investments kicking out dividends and capital gains to you, it's possible to leverage potential loss positions that you are holding to offset the gains you have. And the general idea here is, if you like the holding and its long-term potential, but it's currently in a loss position, you could release that loss in form of selling that stock before year end. And then if you wait 30 days, you can reacquire the same stock, right? Basically resetting your basis, and still claim the loss. The big caveat here is you want to make sure you wait at least 30 days. If you do not, you'll be subject to the wash sale rules, which actually preclude you from claiming the loss you just did all the work to harvest, okay? And the important takeaway from here as well is capital losses can exceed your gains and be deductible up to $3,000 in the current year. If it exceeds that amount, it just rolls over as a carry forward loss to the following period. So other things we talk about year end, some of these are industry specific. It depends on the work you do and what you're involved in. We also talk about, aside from assets, that's a very common one. We talk about, is there any advanced purchasing you can do in the form of materials or supplies you regularly use in work, right? If you've had a really profitable year and you can advance some of your spending that will be January, February, and move it to December, that's potentially a lucrative opportunity to do that. An important thing to note on the asset purchases, we haven't been in an environment since the Trump tax changes at the end of 2017 that we've had the fortune of 100% bonus depreciation on qualifying assets. So we've got into a mindset at year end to say, hey, the tax bill's high, I need new equipment, I'm gonna buy it and fully deduct the depreciation, the asset cost. That's tapered now. Some of the Trump tax changes are sunsetting, so it's leveled off from 100% to 80%. There are the opportunity of using a Section 179 expense on asset purchases, and there's limits in terms of how much you can place in service at a time, and there may be reasons why you would or would not want to do that you'd want to talk to your advisor about in more detail. Another one that's actually been a boon for a lot of folks is the qualified business income deduction, right, known as the QBI deduction. The boilerplate kind of basic of it is as a small business owner, again, disregarded entity or a pass-through entity in forms of partnership or S Corp, your income would generate up to a 20% deduction. Again, there's phase outs, right? We love phase outs in tax law, but that 20% deduction is due to sunset unless they make a provision to extend at the end of 2025. So there's a lot of taxpayers who have seen that benefit, and they're probably just used to getting that benefit for many years now. They will need to do advanced planning when 25 rolls around, assuming no new tax law comes out, to plan around the fact that they're losing a sizable deduction on the individual side there is we're in kind of a fortunate spot. Maybe it's job security for myself, but I do think it's a very interesting time for tax law in general. We've seen more sizable change in tax law in the recent years than we have in quite a period of time. And one of the changes that came about with the Trump tax law was a SALT cap on itemized deductions. And SALT just stands for state and local tax deductions, right? There formerly was no cap. Now there's a cap of $10,000, which certainly in high income tax states, Oregon being one in the form of the income tax, real estate taxes, it's pretty easy to hit the $10,000 cap. We're now in an environment where Oregon passed a law in June of 22 that's still in effect this year and is extended to next year as well, that allows you, if you have a pass-through entity in the form of a partnership or S Corp, you can utilize what's known as an Oregon pass-through entity elective. That's a really long name, but it effectively is a SALT workaround. What it allows you to do is have the business pay your individual tax payments on your behalf by the business. And what that effectively does is creates a federal tax benefit, right? The whole idea is it's a net zero change for the state because you're just paying instead of you personally, the business is paying. But that allows you to get around the SALT limit, okay? What's interesting to me is we're now up to more than 35 states have an equivalent plan in terms of state electives, pass-through electives, I should say. So it's almost comical at this point that the majority of states are working around SALT in one way or another, at least for pass-through or small business owners. So I do expect that this will change in the future, both in the terms of the availability of this type of a program, as well as the SALT cap itself. And actually, I think it was last year, that there was a potential Build Back Better bill on the table. Could be the year before. I apologize there. But the big takeaway here is they proposed in that bill, which didn't pass. So don't worry if you're not up on that potential bill. But they proposed the SALT limit to go to 80,000, right? So this is already a political talking point. You're already getting each side of the aisle arguing over what's more important. And I do feel like this is likely one that gets a lot of attention given the state level mandates or methods to get around the limitation. Okay, a couple other kind of soft ideas to keep in mind that are available to small business owners that aren't available, right, to just an employee themselves is, we recommend, part of our proactive approach is we're trying to educate you on the best way to be proactive and strategic. And so one of the ways you can do that is having a strategic planning retreat, right? And this usually looks like a few days away from the day-to-day grind of running a business. To make plans, right? Review performance, make plans for going ahead and how you'll make changes to make the business more successful. And that'll allow you to, expense effectively the travel, the lodging, and the meals for that type of retreat. The big takeaway here is you don't want to be lavish and extravagant in terms of the expenditures and how you're going about this. But if you're not currently utilizing the retreat, this would be a great year to do that, and ongoing, that should be something you factor into the cycle of your year. We're in holiday season. I hope you all had a good Thanksgiving. So if you have not already, we're in the fortune of having a 100% deductible holiday party. For years during COVID pandemic relief and some of those bills that passed, we had the fortune of claiming as businesses, right? Meals were 100% deductible, right? When they historically had been 50% deductible. That's up through tax year 2022. Now that rule's fallen off. We're back to meals being treated as business meals, I should say, being treated as 50% deductible, but we're still in a position where annual holiday parties are treated as 100% deductible expenditure. All right, so we have a few things here to consider leveraging in terms of an each year opportunity and some things to consider in a high income year specifically. The first one, and I try not to smile when I talk about HSAs because I feel like this is a slightly underutilized opportunity for a lot of folks. An HSA is what in the tax world we refer to as a triple tax advantaged account, which means the money contributed is tax-free, the growth of that account is tax-free, and then qualifying distributions from that account are also tax-free, right? So to be able to fund an HSA, you need to be in a high deductible health plan. So if your facts and circumstances supports having different, high deductible plan, I absolutely encourage it. You can contribute up to $3,850 for a individual and $7,300 for a family coverage. And the idea of the strategy here and the reminder that an HSA is different than an FSA, right? A flex spending account, is the style where you contribute pre-tax to an account to be used for medical expenses that on an annual basis, it's a use it or lose it effectively. So if you didn't have enough medical events, then the benefit effectively evaporates. Now, HSA is nice because it rolls over year to year. And additionally, you can have your HSA account invested in the market, right? Like an S&P 500 or an index fund of sorts. And so quickly you can see how you max fund each year, you allow the account to grow. And the end strategy is that you're paying for medical expenses as they incur out of pocket during your producing working years. And then in retirement, you can reimburse yourself all the way back when the HSA was established. So you'd have a whole history of potential medical events that have occurred that now in retirement, you're receiving a tax-free flow of income to yourself, okay? So yeah, the great opportunity, not a lot of people are leveraging that and leveraging it in the best way. I have some clients with 6-figure HSA accounts, and so it's certainly possible to have some aggressive growth in those categories as well. We have had another recent tax law change in the form of Secure Act 2.0. This had a lot of widespread provisions around retirement, right? And actually one of the things Matt likes to say is that tax law, right, is effectively a social experiment, right? They're trying to incentivize certain behaviors based on the law and how they've structured it. And we'll certainly illustrate that further on. But one of the things they did with Secure Act is they made a 529 plan eligible to be converted to a Roth IRA. So if you have a college-age student that you had funded an IRA for a year, or excuse me, a 529 for years, and maybe they got grants or scholarships that effectively covered schooling, and you have leftover funds in a 529, you can now convert that for each beneficiary to a Roth in their name, which is a fantastic jump on their own retirement. Would also potentially could be utilized in the down payment of their first residence. There's some other options available there, but that's a fantastic point of leverage there. Now, when you have high income tax years, not just talking if you're a high income earner, we're usually thinking in general of when kind of a spike in one year in specific. And that would be for a lot of folks, right? Just business takes off, right? We had some clients where their business was more in demand than ever during COVID, so they had record years. Could also be that you're selling your practice or business and you're having an uncommonly high income tax year. So there's some things we can do to help you plan for that and get around that. A couple of them are related to gain deferment, okay? So the qualified opportunity zone, this is a Trump tax change that again came about with his changes that I don't feel like a lot of people know about, some of the mechanisms and how it's utilized. So the basic rule, right, is a qualified opportunity zone itself is part of a census tract the government has identified as being needing improvement in some way in terms of economic performance, if you will. And so that's one of the behaviors they're trying to incentivize. So they want investment to come into these zones to create job opportunities for the local economy and otherwise. So how do you utilize that as a small, mid-sized business and ultimately a high income individual? Is if you have periods of large capital gains, you can defer some or all of your gain into a qualified opportunity fund, which is invested in those zones. And we're at a point now, if you hold that investment for a 10-year period, you actually would be, you have a step up, which effectively wipes out the taxation of the gain. Now, not everybody can prioritize and park large amounts of capital gains in an investment and not see any value or have access to those funds over a 10-year period. So there's still an opportunity to shift that income to a lower tax year. So if you had a high capital gain year and you're high income for other reasons and you want to shift that from one period to the next, parking the funds in a qualified opportunity fund is a great way to shift that income to a later period, okay? Because it's a gain deferment, you're effectively moving it from one period to the next. That's a great opportunity there. This is available until 12/31/2026, again, barring any tax law changes that would mitigate that. But be aware, this is available there. There are some states that disconnect, ironically, from the federal exemption. One would be California, Mississippi, there's North Carolina, Massachusetts, and New York as well. Ironically, they disconnected on this specifically. There are specific timelines in terms of when you make this investment. Specifically, it needs to be made within 180 days of that capital gain being generated effectively. So certainly talk with your advisor and see if this is an opportunity for you to leverage and make sure you can fit the timing with the need. Another one we talk to our clients about, and this is certainly one that I fall in kind of Matt's line of kind of socially responsible investing in a way. And I say that because if you are already philanthropically inclined, this next option, the donor advised fund, could be potentially a great fit for you in a high income year. And a donor advised fund is effectively a separate entity that you make contributions to, effectively treated as a charitable donation that you get a deduction for in the year you fund. But then you can advise the fund in terms of which charities to send the money to and when. So an example of this is you sell your business and you have $1 million of taxable income and you want to whittle that down. You have expectations over the next 10 years to make contributions to your typical charities, either the form of your church or other 501c3s. So instead of giving the church $200,000 out the gate and then thinking you're going to give them $200,000 every year, you could create a donor advised fund to put $200,000 in that you would get a deduction for in that high income year. And then over time, say a 10-year period, you could have the donor advised fund distribute money to the charities of your choosing over that time. Okay. The next one is quite a popular one, obviously in the real estate world, would be the 1031 exchange, right? This is another gain deferment program. Ultimately, right, you're moving the gain from the sale of real estate into a like-kind property, right? Business or investment property. Traditionally, that's commercial, residential, real estate, as well as land, right? Developed land also would count. But the idea here is you're pivoting from one property to a different property, whether that's several or just a singular one-for-one like exchange. But that's an opportunity to defer that gain in an event of transitioning from a property. Important to note here, there's also strict rules about timing of when that occurs, specifically the relinquished property or that property you're first selling. You have 45 days to identify potential replacement properties. And then after that's done, you have effectively 180 days from the relinquished date to actually close on those properties as well. If that doesn't occur, you effectively break the 1031 and you're going to pay tax on the gain itself. The deferment will be broken. So it's important, right, to be proactive in when those occurrences will happen and be ready to identify and pivot and close on those properties. The other big takeaway here is you have to use a qualified intermediary to accomplish a successful 1031, right? You cannot receive the funds individually at any point. If you do, that's considered taking what they call taxable boot. And once you receive the proceeds, again, the 1031 would be broken. So please don't go rogue on this. If this is something that is of interest of you, certainly talk with your advisor about how best to utilize. There is kind of a nice wrinkle here in terms of a potential opportunity as well to protect yourself further. So once you're deciding to sell and you have the intermediary picked out in terms of to help facilitate the transaction, and you've identified some potential fits in terms of replacement properties themselves, you may also consider as an identified property what's known as a Delaware statutory trust. This would qualify for a 1031 exchange as well. And what's nice is you can use it as a backfill option. So if you had, say you identified 2 physical properties that were available and then they weren't able to be closed on for one reason or another, you'd be eligible to move that over to the DST that you've also identified. And what's nice about a DST is it's effectively, you'll have fractional ownership in real estate as well, right? And so a lot of those come in different flavors, right? There are some that are like retirement facilities, college housing, storage unit type facilities. So that's another option to leverage so you don't get burned on the back end of having a property fall through when you're expecting to close. All right, so a couple just year-end things to consider before we move on to Q&A. If you're an S corporation, we want to make sure you get your W-2 updated to reflect your shareholder health insurance. It's actually a requirement. If you're a 2% or greater shareholder, you're actually required to report your health insurance in box 1 and box 14 of your W-2, but it also allows you to take the self-employed health insurance deduction on your individual return. So be sure that gets on there before year end. Another good thing to capture if you haven't already or aren't doing it on an ongoing basis would be any personal use of a company auto. That's another good one to get on. Into January will be the due date for 1099s. So if you have not already accumulated the W-9s necessary to populate those and report those, I recommend you get on those sooner than later, so you're not up against the deadline there. And this is just a general reminder here in terms of retirement plan. If you have a 401k and you're utilizing your TPA, your third-party administrator, ideally you get the information in terms of your employee census to them as soon as possible, so that by the time your tax return is drafted and prepared, you'll be able to pivot and know exactly how much you want to fund if you're considering a discretionary match or discretionary profit sharing, excuse me. And then lastly, a thing to consider here is your basis. And this would apply to pass-through entities, partnerships, S-corps, and you just want to make sure you have a pulse on where your basis is, so you're avoiding taking distributions in excess of basis. That would be an unnecessary reason to create taxable gain for yourself. You do have the option, right? Basis is calculated 1231, so you have the option of temporarily contributing money back to the business to restore basis, with the expectation of taking the money out after the year changes to January 1. So those are the nice takeaways we have for you there. We're going to open it up for Q&A and welcome Matt back to the party.
All right. Yes, we do have several questions that have come in here, so let's get started. And it's not too late to add a question, so go ahead and drop in any questions that you have. All right, let's start off with Oregon pass-through entity elective tax. We have a question about what taxes can be paid through the business as part of that. Is it just personal income taxes, or would property taxes be included?
Yeah, great question, Teresa. So this program specifically, you pay taxes on what's known as the business's distributive proceeds, which is effectively the business's net income, right? So you would pay, it's effectively under 250,000 of profit, it's 9% that you're eligible to pay. In that way, you can't just have a relevant figure. It's actually a calculated figure you're using. And then likewise, when net income exceeds 250,000, any excess above that is 9.9% of the tax you're eligible to pay in. So yeah, it is more structured than just paying any state-related tax via the business.
Okay, great. Qualified opportunity zones, how long can we keep moving funds to the qualified opportunity zone?
They have 6 months from the sale of the asset to do it. And so it's really when you have a sale of an asset that you have substantial capital gains that you can take advantage of the tax benefits.
Great. All right. Is there a way for a client to move funds from their business to purchase a home without income tax on the amount used?
Yeah, I mean, it's certainly possible. That's definitely one where it's facts and circumstances specific, right? If you had a historical basis built up, your partnership or S corporation, you could take potentially tax-free distributions to accomplish that, but we need a little more facts and circumstances to be certain with that individual circumstances that it would work.
Okay, great. Yeah. Oh, I missed one detail. It's a single member LLC. Sounds like there's some details around the whole thing that would come into play, but in general, it's doable if the situation is right.
Sure. Yeah, it's possible if the facts line up, for sure.
Okay, great. How about this one is for you, Matt. Can you state the book and author that you recommended again earlier, please?
Yeah, it's called E-Myth. They do have some that are specific to industries, but the original book is called E-Myth. The author is Michael Gerber. The overall, and it is available on Amazon. I'm not a shill for Amazon. Full disclosure, I'm a stockholder, but it's $14.44.
Okay, great. Yeah, that sounds like a good one. All right, 1031 exchange. Is this only applicable to investment properties, or can it be primary as well?
Yeah, unfortunately, primary is not eligible. There is a favorable tax law relative to selling your primary residence, which is section 121, the gain exclusion. So if it's been your primary residence for 2 of the last 5 years, as a single individual, you can exclude up to $250,000 of the gain on the sale of your home, and a married couple can exclude up to $500,000. So you're not completely out to dry, but a 1031 is not eligible for a primary residence.
Okay. Let's see here. My advisor and CPA are not at the same firm. How can I get them to coordinate together better?
Yeah, get them to talk first off, introduce them is probably stage one. I always tell my clients, I mean, we have fantastic advisors in-house and I love to leverage them when appropriate. But that doesn't mean I only exclusively work with our in-house advisors. And so my biggest request is that I have a relationship with their advisor. So the right hand knows what the left hand's doing, right? If there's a transaction that occurs on that side of things, I want to know so we can make a tax plan around it. But yeah, the big thing is to kind of bring it as a holistic relationship. Make an introduction, even if you have to be the one to say, hey, I'd love you to meet my advisor or vice versa. That's the best way to accomplish that.
Yeah, I would second that. If you can, create that handshake, that handoff of information, because every financial decision, investment product, insurance product has a corresponding tax benefit or consequence. And most of them, or not all of them, have a disclaimer at the bottom that says this isn't tax advice. You should really talk to your tax advisor before making those decisions.
Great, thank you for that. All right. Can you talk a little bit more about the KPIs? What does that process look like? What information is needed by the ownership group in order for you to provide those services?
Oh yes, like key performance indicators can be particularly lucrative in terms of tracking performance, setting goals and metrics. Some of it is slightly industry specific in terms of certain goals and comparatives you might want to have to industry peers. So that's certainly a consideration. There is also a lot of financial related KPIs that your CPA should be aware of, especially if they're advising you on a proactive basis. So it would be one, having a proactive advisor, right, first out the gate, and then talk to them about, hey, I'm curious about my performance metrics in terms of what is my like liquidity, what's my return on my investment, how are those metrics panning out with my performance relative to my peers is one way to look at it. Yeah.
Well, that's great. I have just one last one here. Okay. First step in setting up a 401k plan for employees, what should be expected in just the responsibilities required?
To set up a 401k, the first steps, do you have an existing plan in place? Even if it's not a 401k, but do you have one of those that we'd mentioned earlier? An idea of what it is that you want to have happen. Are you doing this because you really want to supercharge, you want to start saving for retirement quickly, or you kind of being drug into this because it's sort of like the skin in the game. You got to have one to attract and retain employees. But then the basic data would be your payroll, your census of employees, how many employees you have, what their salary is, and then you can work with our TPAs, our administrators or other administrators, but folks like Jordan, your accountants, they can tell you what the net effect will be on your business return and your personal return, which you're probably very interested in.
Thank you. I see we have a couple of other questions that are sneaking in, but we have come to the end of our time. What I'll say is that I will forward these questions on to our two presenters today, and we'll be able to follow up with you on that. Before we close, we do have a webinar coming up next Tuesday regarding the personal property return for businesses. That forms and letters will be arriving to businesses here in the coming weeks. So be sure to register for that. You can always watch the recording later if you just register. And we just thank both of you, Jordan and Matt, for being here with us today, sharing your expertise. It's been wonderful. We thank everyone who joined us and really hope that you are taking away some good information and some ideas for your year-end action items. All right, have a great afternoon, everyone, and we'll see you at our next small business webinar. Bye-bye.